right, good evening, ladies and gentlemen. Welcome back to episode 2 of the Australian Gold Weekly Review. We're recording this on Saturday, the 16th of August. And just to remind you, this series will focus on weekly movements in gold, silver, oil, as well as movements within the precious metals and mining equities sector. My name is Ved Shah, and joining me is none other than the managing partner at GoldHub Australia, Brian Chu. How are you, Mr. Brian?
Great, Ved. I heard that you flew back from India to Qatar. Is that right?
Yep, that's right. So while we were shooting the previous episode, I was recording from India, and I just came back to Doha, Qatar, which is where I live, yesterday. So, yep.
We're actually, both of us are in slightly different locations for this episode. Mine's a once-off. I'm down in the South Coast for a weekend getaway, but I'll be back up in the Southern Highlands next week.
All right, that's good to hear. I'm just back from my vacation. So, thank you so much, everybody, for your reception for on the first episode. We've got about 700 views within a week, and we're really pleased with the reception that we've received, especially in terms of the feedback. And we're happy to tell you that we've taken into account all of the feedback that you've provided. For starters, I've got myself a lapel mic. There was quite a bit of feedback in the last episode that my voice wasn't loud enough for the viewers to hear. So hopefully my voice is clear now. And we've also agreed to not include any form of background music as we both speak throughout the course of this video, so that you can actually hear what we're saying quite well. And once again, before we start, we would like to let you know that none of the content in this video constitutes financial advice, and that we recommend you seek a licensed expert if you're in pursuit of financial advice. And without any further ado, let's get started with this weekly wrap up, obviously with gold as our first focus. So compared to last week, gold's price has declined by about 0.56%, and it's currently at $3,335 US dollars as of market close. And it wasn't always this case. It wasn't always the case for gold this week, because prices were actually quite higher than US dollars 3,335 midweek, and that was primarily because of the release of the consumer price index, where we've sort of got an inflation data that was much milder than expected, which is 2.7%. And that has sort of almost increased the conviction of the public to 100% in terms of the Federal Reserve cutting interest rates in September. So given that gold's prices are sort of much higher than 3,335 US dollars midweek, but we had the we had the producers pricing index release, I believe, on Thursday or Friday, which was quite positive in terms of movements in the US dollar, as well as treasury yields, which finally caused gold to revert back to US dollars 3,335. Now, at GoldHub Australia, we've projected the CPI to remain the same for the next 3 months, which is 2.7%. And we've also seen that businesses in the US have started to, as well as all over the world, have started to adjust to Trump's tariff policies quite well. So a CPI target of 2% is definitely not something for the short term. And it's something that we should look at in terms of, it's something that we should look at in the long term rather than the short term. And finally, there is a gap between the market's expected inflation based on the Treasury protected securities and a projected flat inflation for 2.7%, which is also quite a bullish signal for gold. So taking all these things into account, Mr. Brian, what do you think is the outlook for gold in the future, considering the macroeconomic environment at the moment?
So we saw that earlier this week, gold actually continued its good run that we saw in the previous week, just after the jobs data, the non-farm payrolls data came out. And gold was poised to break above 3,400 US dollars an ounce, and silver was heading towards 40 US dollars an ounce. And we'll talk about silver a bit later. The US dollar index it was initially heading to 100, and now it ended the week at 97.36, and it's looking bearish once again. We haven't seen the US dollar index at this level for a month. Initially, when Jerome Powell said that the Federal Reserve would hold interest rates, the US dollar looked poised to head to 100. Gold looked poised to pull back to below 3,300. We saw that reverse. I was initially hoping that this time round, at least by the end of the week, the bullish trend in gold rising to $3,400 would actually hold, except it's pulled back. What's very interesting, and we're going to talk a bit more about this too, is that both gold and the US dollar index actually pulled back during the week in tandem. Normally the two, they move in opposite directions, except in recent times, that type of relationship seems to be, I wouldn't say it's breaking, but in the short term, we do see that it doesn't always apply. Now, there are economic implications about this. Number one is there have been perceptions that gold and the US dollar are alternatives, substitutes of each other as a safe haven for money. Except nowadays, that relationship seems to be breaking. And furthermore, because of the greater uncertainty that we're seeing with the economy, with the tariffs, with inflation, with expectations about business and consumer confidence, people are looking for, the markets at least, are looking for a safe haven, and it's clearly the US dollar is slowly being sidelined. I'm not saying it's the end of the US dollar, but it's eroding even further than it has been. Where are people parking their funds? They're parking it in gold, they're parking it in Bitcoin, and they're also parking it in real assets like real estate and land. But ultimately, it seems like the normal that we have seen in the past seems to be further crumbling.
That is actually a really good point to make. And we at GoldHub Australia have focused on this this entire past week. So we conducted a simple correlation analysis between the US dollar index and gold. And as Mr. Brian said, it's sort of a norm that the US dollar index and gold move opposite to each other. That is, when the US dollar index falls down, gold tends to move up. But that's definitely not the case anymore, especially this week where the US dollar index as well as gold have gone down. And have a look at this table for a minute. So if you have a look at a 1 year time span, the correlation between gold and the US dollar index was about minus 0.49. So that's still that's not a very strong correlation, but that's still pretty solid. But if you focus on the correlation between the two metrics in the last 9 months and the last 6 months, gold and the US dollar index have had a correlation of minus 0.88. That is a near perfect correlation, meaning that it is next to obvious that gold would tend to go up if the US dollar index goes down. But if you have a look at the correlation between the two within the last 3 months, and mind you, in the last 3 months, we've sort of seen the peak of geopolitical tensions, uncertainties surrounding tariff policies, and whatnot. So in a macroeconomic environment as volatile as this, the correlation between the US dollar index and gold in the last 3 months is only minus 0.15. Now, that's still a negative correlation, which may suggest that they still tend to move in directions opposite to one another. The magnitude is only 0.15, which is an extremely weak correlation and a change of 84% compared to the 6-month and the 9-month correlation. So what do you have to say about this significant drop in correlation between the two?
So Ved, our colleague Trung Tai, who is who's also a partner in GoldHub Australia, and he's worked with me for almost 4 years. we've been discussing about this relationship, and he's quite in the macroeconomic side of macroeconomic analysis and looking at these types of things. And he's been pointing out to me that the relationship between gold and the US dollar, this negative correlation, seems to be falling apart. Now, I would say it's in the short term, yes, but if we do a longer term correlation analysis and you also visually look at the relationship between the US dollar index and gold, they do tend to move, at least in the medium to long term, they move in opposite directions. In the short term, there are fluctuations, as you said correctly, Ved, that there are geopolitical tensions. We've had recently a series of geopolitical events that have caused a bit of alarm and concern in the world. The Israel-Palestinian conflict. Then you had Israel and Iran. Then the US bombing of the 3 nuclear facilities in Iran. All these caused people to fear that a nuclear war might be on the cards. And fortunately, that did not eventuate. It was something that I had pointed out it was unlikely to happen. And I'm glad that it hasn't. So a notch under the belt for us here. We called it. But the thing is, when you have such events where there's a lot of fear, the two, both gold and the US dollar index, they will rise together as opposed to moving in opposite directions because it becomes a flight to safety. And that's why the correlation between gold and the US dollar moved from being strongly negative to insignificant, even though there's still a negative correlation. But if you put that under a statistical test, it is very likely to be insignificant. If we have further uncertainty and there are greater economic troubles ahead, should, for example, the tariff wars really blow over, or the tech boom that we're watching actually falls apart, and people move back to safety, the flight to safety, then this correlation between gold and the US dollar in the short term will probably be even moving to positive, signaling flight to safety. At the moment, I would say a lot of people like to focus on what's happening in the daily sense, the weekly sense, and they might make their decisions accordingly. I still think in the medium to long term, that relationship between the US dollar index and gold continue to hold, but it is continuing to weaken as people find alternative safe havens than not gold, but they're looking for alternatives away from the US dollar, more towards gold, more towards cryptocurrency, Bitcoin, not just any old tokens, and perhaps real assets.
Right, that's interesting. So a way to sum it up would basically be that in times of uncertainty, people run to the US dollar as well as gold to seek safe haven. And as a result of that, in periods such as these, it is plausible to see both of them rise together, or maybe even fall together if the environment sort of is conducive for the same. All right, let's move on to silver, crude oil, and the gold-oil ratio, which is the second part of our discussion. So if you have a look at silver sort of mimicked gold's movements this week, except for the fact that by the end of it, silver was up by 0.68% compared to gold, which was down by 0.56%. Now, silver has yet again crossed the $38 mark, and this has not got anything specifically to do with silver, but the fact that in times of uncertainty such as these, people increase their inflow into precious metals such as silver and gold. And given that silver has got sort of a lot of new gen industrial use cases, I think it's quite plausible to see silver continue to rise in times of uncertainty, even if gold falls down. Now, moving on to crude oil. Crude oil went down by about 2% this week, which is a 2-month low to US dollars 62.095. And Reuters have reported that oil prices tumbled down to 2-month lows, with the Brent down 0.7%, following bearish supply guidance from the US government and the International Energy Agency. And as a result of that, WTI crude oil followed suit with Brent crude oil, which was down by 0.7%, as we said. And as a result of falling gold prices as well as oil prices, the gold oil ratio has dipped as well this week, from 53.78 to 52.94 barrels per ounce this week. So what do you have to say on the price falls in crude oil as well as the fall in the gold oil ratio? And I also know that you've got a specific comment to make on silver holding up and the critical US dollar 40 level potentially causing more investors to pay attention to gold stocks. So what do you have to say on these topics?
Yep, so let's start with silver. So silver behaves both as a precious metal and an industrial metal because of its versatility. In times of, in normal markets, silver behaves more like industrial metal because that's how the trades tend to gravitate towards. So a rising price of silver often reflects a stronger general economy. Silver is not so much a safe haven metal as you would see with gold. Silver is also what I call a FOMO metal in the precious metal space. What I mean by a FOMO metal is, in a bull market, gold leads, silver follows. But silver doesn't follow that closely to gold. And one day I'll show you guys all the correlation studies that I have done on gold and silver, and it's quite fascinating. Silver catches up in the latter stages of a precious metals bull market, which I believe we're starting to enter one right now. And that's why silver has done very well this year. I think silver has outperformed gold year to date, which is quite a impressive performance. And what I'm looking for is silver rising above $40 an ounce. It broke above 35 and held it at that level since May. And that is quite significant because it marks a new era where in this precious metals market, people realize, at least the general market, they see that it's not just a simple gold commodity cycle where gold does really well for a few years and then it pulls back and gives back most of its gains. It seems to have held the gains. It has gone up even further. The moves have been very impressive. I've been to the point where even a gold bull like myself, I'm actually expressing a bit of hesitation about how much further it can go. And I am not so much saying chase this bull all the way to the top, but I'm going watch what happens, try to understand the context. Now, silver's catching up, similar story. The $40 mark is critical because it marks yet another psychological level. Now, what could this mean? Is that should silver rise to above 40, my suspicion is the broader market will pay attention even more on gold mining companies, because that would be the next logical place to put their funds in after having watched gold double in five years and having gone up by 70% in the last year and a half. To chase the gold bull from here may not be as rewarding as if you go and buy gold mining stocks. At least That's what the perception would be. I'm not saying this is what you should do. It is something that you should be very careful about. I'm quite cautious. That's what I'm communicating with my newsletter readers that signed up for my services in Factor Investment Research. You can check the links below. Now moving on to oil and gold to oil ratio. Oil is a very important commodity in our economy. Of course, our economy still runs predominantly on oil. Businesses run predominantly on oil, and mining companies also, their budget, at least 25% of their budget is on spending on fuel. So that actually affects the margins of the company because it costs input. Now, the gold to oil ratio, not a lot of people hear much about it. Maybe they're starting to gain a bit more recognition because it's now picking up pace as a useful metric to capture. The gold to oil ratio, what the significance for our business is, the higher the gold to oil ratio, as in the more barrels of oil an ounce of gold buys, it implies that the producers, especially the companies that are mining gold and selling it, their margins, the profitability rises because they receive more for the gold that they sell, but they spend less relatively on the inputs, on the machinery to run the trucks and the processing plants, etc., in the mines. So the gold to oil ratio is at a unusually high level. I'm not really sure as to whether this is a new normal or not, but it's been sitting at above 50 for at least 4 to 5 months, and this is conducive to gold mining companies continuing to deliver strong margins, which is why gold stocks are actually doing well. But how long is this going to last? It really depends on whether the economy continues to behave as it does, allowing gold to continually be valued much higher relative to oil.
Right. And I think now is a good time to talk about the ASX All Ordinaries Gold Index, given that we've talked quite a lot about the gold oil ratio, because as you said, we believe that the two are quite correlated, at least for now. So the ASX All Ordinaries Gold Index is up by 221 points this week to 12,217 points. And a part of the reason is because of standout results by certain producers due to increasing margins, such as Evolution Mining, whose FY25 net income doubled this year compared to last year, which helped boost the buying interest. And companies like these are among the largest producers of gold in Australia. And therefore, they've got quite a big influence on the ASX All Ordinaries Gold Index. Now, the question is that gold's daily or weekly moves don't always lead the index to move in the same way. We saw gold decrease by 0.56% this week, but that did not mean that the All Ordinaries Gold Index fell by a certain number of points this week. Quite the contrary, it increased by 221 points this week and about 321 points in the last 5 days. So how important is it to have a look at the longer term horizon in terms of gold prices and consider investor sentiment as well as the gold oil ratio while evaluating how the ASX All Ordinaries Gold Index is performing?
Well, if we look at the ASX Gold Index in the past year, it's had a phenomenal run. If I recall correctly, same time last year, this was before the first rate cut of this cycle, which happened in September. The ASX Gold Index was sitting at around 8,000 points, and it's increased by almost, if not above 50% in the past 12 months. That's an unusual move. If you look at any industry that moves 50% in 1 year, that's a bull market on steroids. And we have seen the ASX Gold Index It bottomed in around October 2022. So we're almost 3 years into this bull market. I think at the bottom of this cycle in October or late September 2022, it was 4,245 points, where actually we've seen this index rise by almost 200% now. At the highest in mid-June, just after the Iran and Israel started kicking off firing missiles at each other, the ASX Gold Index went to as high as 13,400 points, and it pulled back since. Late last month, I think it found a low at about 10,800 points, and it's on the road to recovery at the moment. Now, gold does a lot of people would try to map how gold stocks are going to perform based on how gold performs. But we have shown in our own study, and we've talked about the mechanism of why it's the gold to oil ratio that drives gold mining stock performance, is simply because profit margin, companies, you value companies based on their profit margin more than just simply the price of the of what they sell. So you can think of it this way. Let's say with a oil refinery, the oil refinery doesn't only go up in price, or they don't become more profitable just because the price of oil goes up. It's the efficiency of the market. It's the efficiency, not the market. It's the efficiency of the company that determines their profitability. And the more profitable the company is, then typically the valuation should go up. Or at least the valuation of the company is justified. If merely the price of gold goes up, but the company's profit margins are not, but the price is going up, I can tell you this, the market may be jumping in to buy these gold stocks because of the whole momentum. They go, gold's up, I'm going to buy gold mining companies. People like me, I'm actually going to be selling if I see that the prices are going up faster than the operating margins and the profitability of these companies, because the price goes up just means to me it's overvalued, and I do much better selling to everyone who's clamoring on board, and I'll come back in when the price comes down faster than the operating margin profitability comes down, because the price coming down tells me it's good value.
Right. So I think we've emphasized in this commentary video as to how important it is to sort of factor in the operating margins of the company in conjunction to movements in their stock price as well as gold prices, and how important the gold-oil ratio is in defining how fat or thin those margins are going to be. So we're done with that section of our commentary now, where we comment on the index, and we move on to the last section of this commentary video, where we discuss one of the top 10 gainers and losers this week, and talk about a specific company in focus. And all these three companies are going to be different, quite obviously. So let's start with one of the companies from the top 10 gainers on the ASX this week, and this is only mining companies that we're talking about. So the company that we want to focus on is the biggest gainer this week across all precious metals and mining companies, and that would be Dateline Resources Limited. Now, Dateline Resources Limited has posted a return of 52% only this week, and that is because alongside their 1 million ounce resource deposit in California, where their approved gold project stands, they've also conducted a few tests to nearly conclude the fact, or to sort of shed light on the fact that aside from gold resources, there may be rare earth elements as well that have got several industrial use cases. And they've got the highest quality rare earth elements, which are at par with the quality of the rare earth elements supplied by Mountain Pass, which is the mine that is responsible for the largest supply of rare earth elements in the world by magnitude. And it is simply this piece of news that has sort of created a huge speculative upside for this company, and which led to a 52% increase in their stock price this week. And as far as the top 10 losers are concerned, the company that we want to focus on would be Gorilla Gold, Gorilla Gold Mines Limited. And they've gone down by nearly 20% this week. There isn't any news that we've found that could support a price drop as big as 20%. But what we know so far is the drilling results published by the company this week on the ASX announcements board were not at par with investors' expectations, despite being positive in their absolute nature. So what would you have to say about this fall in Gorilla Gold Mines Limited, despite the fact that their results aren't exactly disappointing, but they aren't at par with investor expectations?
So Gorilla Gold has had a very good year if you look at their share price since the beginning of the year. It's one of the biggest gainers in the gold stocks side of things, and it came about because of discovery of very good grades in their Comet Vale deposit, and I think the momentum carried it forward, and at the same time, a lot of people then started paying attention because on Australia's largest stock discussion forum, Hot Copper, people have been following that, and lots of comments on every piece of news that the company has released. But the reason why there was a pullback, and I don't think this pullback is really changes the story about the company. The narrative still remains the same. Comet Vale seems to be something that people should be paying attention to. But the drill results that came out was mediocre in the sense that if you take the length of the best hole that was announced, multiplied by the grade, it was well less than 50 grams per ton meters. Now, it's a very technical term. If you want to understand how to analyze drill results, I encourage you to watch a video by a very well-known analyst in this field, Don Durrett, who is based in America. He has a website called goldstockdata.com. I actually know Don, and I've had conversations with him. A lot of my work actually was inspired by his. Smart man, and when it comes to analyzing these types of things, he's very good with it. And he taught me, he's actually published a rule of thumb on analyzing what are good drill results. So if you want to find out more about that, dig into it, then go back and have a look at Gorilla Gold's news release, and compare it to some of the recent drill results that led to the price jumping. Then you'll realize why the share price actually came back down quite a bit, partly profit taking, partly also underwhelming results. But story hasn't changed.
Right. So that sort of does emphasize the importance of knowing the technical details of drilling results and the geology behind what goes on in terms of productions and exploration at mining companies, and how equally important that is in defining the movements in their stock prices. So we do recommend that you watch the video suggested by Mr. Brian. The name of the video presenter is Mr. Don Durrett, who is a very renowned analyst in the metals and mining space. Right, so a lot of exciting stuff we've covered today. Right, we're at the end of things now. We've got everything covered, and I would say the most important things that we've covered for this session is starting off with the lack of correlation between the US dollar index and gold. Please keep in mind that the US dollar as well as gold are two such asset classes or parts of asset classes that people rush to in times of uncertainty. And as a result of that, their correlation has been weakening over time. to the extent where they've got a significantly weak negative correlation between the US dollar index and gold. The second is the development of the standardized operating margin by Mr. Brian at GoldHub Australia, and the importance of considering whether a company hedges their gold sales or not, and whether it provides a fair or an unfair advantage to the specific company. More about that metric for a video in the future. And the last part, and in the last part of this commentary, we also discussed the importance of the gold oil ratio and how important crude oil prices are. I would say as important as movements in gold prices, because that is what defines the operating margins of the company. And it is very important to look at any company's stock price movements through the lens of the operating margins and the movements in crude oil, as that could really define the movements of the company's stock prices in the future as well. And before we wrap up, we'd just like to let you know once again that none of the contents in this video qualify as financial advice. And our intention of this video is to educate and entertain you. And we hope that we've achieved both, and at least one of the two. And our vision is definitely to achieve both to the best of our abilities coming into the future. And once again, this is a joint project between us and you. And we would welcome any form of feedback that you have to give us for this episode and for the series as well. And we'll definitely take your recommendations and feedback into account as we did for this specific episode. So with that said, I think it is a good time to let Mr. Brian continue with his holidays and for yourself to continue with your precious time as well. And thank you so much for tuning in, and we'll see you in the next episode.
Yeah, one thing that I'd like to add is on the education and the entertainment part. If this doesn't deliver, I guess the only thing that we'll have to do is break out in song and dance. And I'm not sure whether I'll be able to carry this one. You'll probably have to do that bit, Ved.
Yeah, I'm not sure if I could do it either. So we're going to have to get one of the other partners at GoldHub Australia and maybe some other analyst or employee to continue with the same.
Or maybe AI.
All right. On that note, I think this is a good time to wrap up the session. Thank you so much, everybody, for tuning in. We welcome all your feedback, and we will see you in episode 3 of the Australian Gold Weekly Review. Thank you so much, everyone.
Thanks very much, and everyone, God bless.